Hello everyone, this is a video made for students who attend classes at on Friday at 9:30 a.m. Okay, due to fair evacuation last week, we couldn't finish our tutorial, so this video is just for those content that we couldn't finish last week. Okay, now we have already discussed the main differences between tax and accounting treatment. There are four main categories. The first categories are those accrued items. For instance, when we have provision for annual leave and long service leave, those expenses, even though we recognize them, it won't be deducted for tax purpose until we actually paid the annual leave or long service leave. Okay, also if we have any insurance or rent or anything that we paid in advance, there's also these are also accrued item, so there are some timing differences that we need to adjust. Okay, the second category are valuation items. Okay, one of the typical example is impairment loss of goodwill. Now, because goodwill itself is intangible assets, it's hard to determine its value. So when we impair goodwill, it's a very subjective accounting treatment. So it's not deductible for tax purpose. The third main category are those items that are non-deductible. Now, with non-deductible item is what we call a typical one-step item, because all you need to do with non-deductible items is to add it back. Okay, typical example, fine and penalties, and also entertainment costs. These costs were deducted from your accounting profit. Okay, to deduct it from your accounting revenue to calculate your profit. However, they are not deductible for tax purpose. Therefore, you need to add it back to your accounting profit. The last category are tax incentives. So, for instance, research and development. Sometimes government trying to encourage more research and development. So, government do allow companies to claim tax deduction for up to 120% or 150% of the money they spend on R&D. Okay. Also, if we have tax losses, government allows companies to carry the tax losses to the next period as a deduction for any tax profit they made in the subsequent years. Okay, so those are the four common differences between tax and accounting treatment. Because of these differences, we actually need to adjust our accounting profits to make it to the taxable profit. Okay, so let's try a simple question first to get you familiar with the current tax worksheet system, and then we'll try a harder question. Okay, so the first question we're going to do is the question 6.2. As you can see, there are four cases. We're not going to cover all of them because case 2 and case 3 are very similar to case 1. So we're probably only going to be covering case 1 and case 4. So if you look at case 1, whenever we do current tax worksheet, we're always starting with the profit before income tax. Okay, so in case 1, the profit before tax is 40,000. So we're starting with that figure. And then we have a look of all the items under the accounting profit. The first item we have is goodwill impairment loss. As I said, goodwill impairment loss is one of the valuation item. It is not deductible for tax purpose. Okay, so with non-deductible item, the only thing you need to do is to add it back. End of the story, done. Okay, so whenever you have goodwill impairment loss, all you need to do is to add it back. Okay. Second item, entertainment costs. Again, this is another non-deductible item. With non-deductible item, the only thing you need to do is to add it back. Okay, one-step item. You don't need to think about anything else. Okay, so if you have any entertainment costs, it was originally deducted from your accounting revenue to calculate your accounting profit. However, it is not deductible for tax purpose, so you need to add it back to your accounting profit. The third item is donation to political party. As you can see in the additional information, the donation to political party is not deductible for tax purpose. So with non-deductible item, all you need to do is to add it back to your accounting profit. Okay. Right. Next item is depreciation expense. Now the depreciation expense generally they always different under tax and under accounting. So tax office will have their own rate of depreciation, whereas under accounting company may have different rate of their own depreciation rate. Right? So when we calculate our accounting profit, we use the rate that we apply in our own company to calculate our own depreciation expense. Unfortunately, that is not deductible for tax purpose. Only the depreciation calculated using the rates set by the tax office are deductible. In this case, we have 4,000 depreciation for accounting purpose, which is the rate that we use in our own company. But and for the tax office, they decided that our tax depreciation will be 8,000. Okay, now the tax depreciation will be the one that is deductible, whereas the depreciation expense we calculated for accounting purpose is not deductible. Okay, if it is not deductible, then we need to add it back. Whereas for the tax depreciation, which calculated using the rate set by the tax office, is deductible for tax purpose. Okay, so we need to subtract that item. Okay, so here we add back a goodwill, we add back the donation of 1,000 because they both non-deductible item, and with depreciation expense, the accounting one, it is not deductible for tax purpose, the 4,000, because it's calculated using accounting rate, so we add it back. Whereas for the 8,000 tax depreciation, that is calculated using the tax rate set by the tax office. It is deductible for tax purpose, so we will subtract that item. Okay, so for depreciation, it's a two-step item. So when you add something, you will subtract something else, or if you subtract something, you will add something else. Okay, so it generally comes in pair. Okay, the next item, which is similar to depreciation, is long service leave expense. This is also a two-step item. Okay, so basically you need to figure out the tax one, you need to figure out the accounting one. Okay, so here under accounting we have a long service leave expense of $600. Okay, but if you think of this long service leave expense, when you increase your long service leave expense, you will debit your long service leave expense and you credit your provision for long service leave, right? Does this transaction involve any cash at all? No, not really. Okay, so with long service leave expense, you won't get a deduction for that until you actually pay for it. Okay, so even if we recognize a long service leave expense of $600, doesn't necessarily mean that we paid $600 this year for long service leave. And for most long service leave, we won't pay it until probably 10 years or 5 years, 10 years later. Okay, so in this case, as you can see, the long service leave expense recognized under accounting purpose is $600, but we didn't actually pay any long service leave this year at all. Okay, so is this $600 deductible for tax purpose? Unfortunately, no. Okay, you only get a deduction until you pay for that long service leave. Okay, so here we need to add back the $600 because we didn't pay for that in cash. Okay, and we deduct the amount we actually paid for long service leave. However, we didn't pay anything for long service leave. Okay, so in your test exam, if the item is 0, just leave it out. You don't actually need to write this item if it is 0. Okay, so once you figure out the different how much you need to add it back, how much you need to deduct, then you get a total of all these add and subtractions. Okay, so as you can see here, we have a positive figure, 43,600, which is our taxable income. Okay, and the current tax rate in Australia is 30%. So if we multiply that by 30%, that will be our current tax liability, which is how much tax we will pay this year. Okay. When you have a tax you need to pay this year, you need to recognize the corresponding expense. So you will debit your income tax expense and you will credit your current tax liability because this is how much tax you need to pay this year. Okay. Alright, moving on to case 4. Okay, as I said, I'm not going to go through case 2 and 3. You can try those cases yourself. Now, have a look at case 4. We're not starting with accounting profit. Instead, we're actually starting with accounting loss. Okay, so we had a loss last year of 10,000. As I said, tax loss is part of your tax incentive. You can use it as part of your deduction if you actually made a profit this year. Okay, so here we have a tax loss of we have a loss from last year of 10,000. Okay, and let's go through each of the item again. We have 8,000 of goodwill impairment loss. Goodwill impairment loss is non-deductible, so what do? We add it back. Okay, so we add it back straight away. The 8,000 done. Okay, the next item we have is depreciation expense. So under accounting, the depreciation expense is 2,000, whereas under tax, the depreciation is 4,000. Okay, which one is deductible? The depreciation calculated using the tax rate is deductible. Okay, so the depreciation for tax purpose is deductible. Okay, whereas the depreciation expense under accounting, which is using the rates within the company, that's 2,000, that is not deductible. Okay, so what do we do if it is not deductible? We add it back. What do we do with the 4,000, which is actually deductible for tax purpose? We subtract. Okay, so they come in pair. Okay, so don't do like all your addings and then do all your subtractions. You won't be able to do that, so make sure you do one add and then one subtraction. They generally come together. Okay, all right. The next item is the long service leave expense. Again, whenever we have long service leave expense, doesn't necessarily mean that we paid for those money. Okay, so we recognize the long service leave expense of 1,200, but it doesn't necessarily mean that we paid for 1,200. Okay, so how much we actually paid for long service leave? In this case, we paid 2,400 for long service leave. Okay, so we will get a deduction when we pay for long service leave. And how much is it we paid? We paid 2,400. That is deductible for tax purpose. Whereas the 1,200, which is the expense recognized for accounting purpose, that's not deductible. Okay, so if it's not deductible, we need to add it back. And for the 2,400, which is actually paid in cash, it is deductible for tax purpose, so we need to subtract that. Okay, now once you adding all this together and subtract those deductible items, you will end up with a tax loss of 5,200. Okay, when you have a tax loss, do you need to pay any tax? No. Okay, you only pay tax when you have a taxable income. Unfortunately, we still have a loss this year, so we have a loss of 5,200. Okay, which means we don't need to pay any tax this year, so we don't have any current tax liability. But remember, tax loss is, we do have the tax incentive, so we can carry this tax loss again to next year, which means we will pay less tax in the future with this tax loss as a deduction, right? So if we pay less tax in the future, it's part of our assets, right? So we debit our deferred tax assets because we will pay less tax in the future, and we credit the income tax income, or you can say income tax expense, the interchangeable. Okay, because we pay less tax, it's part of our benefit that we will receive in the future, so we need to recognize that as part of our income. Okay, right, so those are two relatively easier case. Okay, so once you get familiar with the whole system of current tax worksheet, we will be able to do harder question. Okay, so the question I want to cover with you today, the harder question is 6.10, part A. Okay, so this is a fairly big question. So as you can see, we have both the statement of profit and loss and a statement of financial position, which is the balance sheet. Okay, now generally when you do your current tax worksheet, you mainly focusing on the income statement, but you do need support from the balance sheet. So you do need some balances from the balance sheet, but the main thing you need to go through is the profit and loss statement. So every single item under the profit and loss statement, you have to go through them. Okay, now with the profit and loss statement, we do have a lot of items here, right? So how do we go through each of them? This item, well, you need to first of all be clear about one thing. So when you say all these expense and all these revenues here, okay, we need to make an assumption. Okay, so first of all, I want you to have a look of all these items and think about whether they are paid in cash or not. Okay, so the general assumption is, if you look at all these accounts under profit and loss statement, if they do have a corresponding account, then we would assume the expense is not paid in cash. Okay, for instance, if you say insurance expense, okay, so we have an insurance expense account, but if you go to the statement of financial position, you will say here we have a prepaid insurance. Okay, which means the insurance expense of 50,000 doesn't necessarily mean that we paid the whole amount in cash, because we do have a prepaid insurance account. Whenever we have a corresponding account in the financial position, the first thing you need to do is to set up your T account to actually work out the cash component. Okay, so it's really important for you to know if there's corresponding account. Okay. On the contrary, if you look at for instance, the motor vehicle expense, can you find a corresponding account in the financial position? Not really, right? There isn't a corresponding account for motor vehicle expense. So what's our assumption? If there's no corresponding account in financial position, it means that we must have paid this expense in cash, right? If we pay this expense in cash, then there's no difference between accounting and tax amount, right? Because we already paid all this expense in cash, which means we don't actually need to adjust for anything. Okay, so that's a little trick of how you identify which account need to reconstruct a T account. Okay, so this is a very comprehensive question. There are a lot of items here. There are a lot of additional information, as you can see from here. Okay, so how do you tackle this kind of question? Now, the first thing I want you to do is that I want you to look through every single item under your profit and loss statement and see if there is any corresponding account. Okay, and just one more information, with service revenue, that's the only item under tax that we don't treat it on cash basis. So we take sales revenue on accrual basis. So even though the sales revenue 900,000, we didn't receive all the money for the sales revenue, we still tax on the 900,000 basis. Okay, so we don't adjusting for the sales revenue. So just ignore sales revenue, take it as it is. Okay, but for every other item, you need to look and see if there's any adjustment needed. Okay, so the first step, let's have a look of this profit and loss statement and see if there's non-deductible item. Okay, so if you look through the list under statement of profit and loss, we do have the first non-deductible item is the entertainment expense. Okay, so entertainment expense is a non-deductible item. So what do you do with non-deductible item? You need to add it back. Okay, there's another non-deductible item which is not quite common, but if you look at additional information, in additional information C, it says that there is a legal fee of 3,800. It is capital in nature, so it is non-deductible for tax purpose. So this is our second non-deductible item. So whenever we have non-deductible item, all we need to do is to add it back. So whenever you do your current tax worksheet question, the first thing you do, you just add back all your non-deductible item, and then you take that item off your list, so you don't need to think about that anymore. Okay, so let's have a look of the answer. So the first two things we do, we add back our two non-deductible items. The first one, entertainment expense. The second one is the legal expenses. Okay, so they both non-deductible. Okay, alright, so once we're done with this non-deductible item, then we can move on to those items that do have a corresponding account or have additional information that need our attention. Okay, so the first item we're gonna have a look is the insurance expense. Okay, remember I said before, insurance expense, we do have a corresponding account, and that account is prepaid insurance. Okay, if we have a corresponding account, the first thing you do, set up your T accounts, because you need to work out how much we actually paid in cash for the insurance. Why do we need to know the cash component? Because for insurance expense, you won't get a deduction until you actually paid in cash. Right, so it doesn't matter when you used up your insurance, it doesn't concern the tax office. They only want to know when did you pay for your insurance in cash. Once you paid in cash, you will get deduction for that. Okay, so let's set up a T account for the prepaid insurance. So here we have the prepaid insurance account. Now prepaid insurance is part of your assets, so your opening balance will be on the debit side, closing balance will be on the credit side. Okay, so now I want you to think about whether your insurance expense will increase your prepaid insurance or decrease your prepaid insurance. Okay, so when you have a insurance expense, basically it means that you used up your insurance, right? If you used up your insurance, it means that it's decreasing your prepaid insurance. If it is decreasing your prepaid insurance, it will be on the credit side. Okay, so you will put your insurance expense on the credit side. So how much you will actually paid in cash for the prepaid insurance? It's the missing part on the left hand side, right? You have your calculator, you can do your own math. Okay, so the actual cash we paid for insurance in this year is 55,950. Okay, so which one is deductible? The 50,000 expense under accounting or the 55,950 under tax purpose, which is the insurance we actually paid in cash? The cash one is actually deductible. Okay, so the 55,950 is deductible for tax purpose, whereas the 50,000 accounting expense is not deductible. If it is not deductible, we need to add it back, whereas for the cash we paid for insurance is deductible, so we will subtract that item. So let's have a look of the answer. So we will add back which one? The accounting expense, right? 50,000 because it's not deductible. The actual deductible one is the one that we paid in cash. Okay, and please notice that here they all comes in pairs. Okay, so insurance expense we add back, at the same time we will subtract how much insurance we paid, which is actually deductible. So those are typical two-step items, so make sure you do them in pairs, okay, so that you don't forget any of these items. Okay, right, so let's move on to the second item. The second item here is the accounting fee. Okay, so for accounting fee, we don't have a corresponding account, but we do have additional information. Let's have a look of additional information. So in the additional information, the question tells you that in additional information D, the question tells you that we have an accounting fee of 4,500, which is the accounting work that hasn't been performed yet. Okay, and it tells you that for tax purpose, the accounting fee are not deductible. On the accounting fee are deductible only if the work has been performed. Okay, so basically, if the work hasn't been performed, you cannot use it as a deduction. Okay, so how much accounting fee we have this year? The accounting fee we have this year is 5,500. Okay, out of these 5,500, there are 4,500 work hasn't been performed yet. So how much of the work has been performed? It is 5,500 minus 4,500 give you a difference of 1,000. This is the work that has already been performed and it can be used as a deduction. Okay, so what do we do with this 1,000? Because it's deductible for tax purpose, we will subtract this item. Whereas for the 5,500, which is expense under the accounting, okay, it's not deductible for tax purpose, so we will add it back. Okay, so for the accounting one, 5,500, we will add it back, and the actual deductible amount is 1,000, which we will subtract. Okay, the third item we're gonna have a look is the bad and doubtful debt. Okay, so for the bad and doubtful debt, let's have a look. Bad and doubtful debt. We have a balance of 19,500. Okay, but when can you use bad and doubtful debt as a deduction? You won't be able to use it as a deduction until you actually written off your bad debt. Until your debtor actually call you, says, okay, we can't pay you anymore. Okay, that's the time you can actually use bad debt as a deduction. Okay, until that time, it's not a deduction. Okay, so we need to work out how much bad debt we actually written off this year. Okay, so how do we work it out? We do have a corresponding account. What is the corresponding account? It's the allowance for doubtful debt. So let's set up a T account and see how much bad debt we actually written off this year. Okay, so let's have a look of the T account. Allowance for doubtful debt is a contra asset, so it's a credit nature account. Opening balance on the credit side, closing balance on the debit side. Okay, so now you need to think about whether your doubtful debt expense will increase your loans for doubtful debt or decrease the loans for doubtful debt. Now think about the transaction we do when we set up a loans for doubtful debt. We will debit the doubtful debt expense and we will credit the allowance for doubtful debt. Okay, so your allowance for doubtful debt increase at the same time when your doubtful debt expense increase. Okay, so when you have doubtful debt expense, it will increase your loans for doubtful debt. So it's on the credit side. So the expense will increase your loans for doubtful debt. Okay, so how much doubtful debt or bad debt we actually written off this year is the missing part on the left hand side. Okay, so we written off bad debt for 1,500. Okay, so which one is deductible for tax purpose? The doubtful debt expense of 19,500 or the bad debt we actually written off, which is 1,500. It's the written off one, right? So you won't get a deduction until you actually written off your doubtful debt or bad debt. Okay, so 1,500 is deductible for tax purpose. What do? We subtract. The expense of 19,500 is only for accounting purpose. It will not be a deduction to you until you actually written it off. Okay, so what do you do with non-deductible item? You add it back. Okay, so let's have a look of the answer. So what do you add back? You add back the doubtful debt expense under accounting, which is 19,500, and you subtract the bad debts you actually written off this year, which is 1,500. Okay. Right, next item, we're going to have a look of the depreciation of equipment. Okay, so for depreciation of equipment, we do have a corresponding account, which is the accumulated depreciation. However, it won't help us because the difference between depreciation is not about cash, it's really about the rate differences. Okay, so under tax and accounting, they have different rates of depreciation. So how much is the depreciation under tax purpose? Now, if you have a look of additional information B, it tells you that the tax written down value of the equipment in 2017 is 28,000 and in 2016 is 35,000. So what do we mean by tax written down value? Basically, it is the carry amount. It is the carry amount under tax purpose. So basically, if you use your original cost of the item minus your tax accumulated depreciation will be your tax written down value. Okay, so basically it's like the tax version of the carry amount. Okay, so if your carry amount for tax purpose was 35,000 last year and 28,000 this year, how much is your depreciation? It's the difference there, right? It's the 7,000 difference there. Okay, so you have a accounting depreciation, which is 5,500, and you have a tax depreciation, which is 7,000. Which one is deductible for tax purpose? Apparently, the depreciation calculated to use the tax rate, right? So 7,000 will be deductible for tax purpose, whereas the 5,500 will not be deductible for tax purpose because it's using our own corporation's depreciation rate, right? So we need to use the tax office rate, which is 7,000. Okay, so what do you do with 5,500, which is not deductible? You add it back. Okay, what do you do with the 7,000, which is deductible for tax purpose? You need to subtract. Okay. All right, moving on. Next item we're gonna have a look is the reconstructing costs. Okay, so with the reconstructing costs, we do have a corresponding account which is called provision for restructuring. Okay, now when you see a corresponding account, the first thing you do is T account. So you need to set up a T account for the restructuring costs. Okay, now what you can do instead of setting up a T account is that you can have a look of the account balance. So restructuring costs is 23,000 for this year, okay, and the provision for restructuring is 23 as well. So did we actually paid anything for restructuring? Not really, right? So you can set up a T account if you want. So let me show you the T account. Here's a T account. Provision for the restructuring is a liability account. So opening balance on the credit side, and closing balance on the debit side, right? Think about the transaction of setup provision. So basically, you will debit your restructuring expense and you will credit your provision for restructuring. So if you have a same amount in your provision for restructuring, 23,000, and you have the same amount in your restructuring cost, 23,000, it means you pretty much didn't pay anything. Okay, so your restructuring expense will increase your provision for restructuring, which means your expense go on the right hand side. Okay, so 23,000, which means you paid nothing for restructuring. Okay, so same thing as the provision for annual leave or the provision for long service leave. Provision for restructuring will not be a deduction until you actually paid for it. Okay, so what do we do with this 23,000? Because we didn't pay any of that, the total amount of 23,000 is not deductible for tax purpose. So if it is not deductible for tax purpose, what would you do with it? You will add it back. Okay, so we'll add back your restructuring expense. And if you actually paid anything in cash, you can use it as a deduction. Unfortunately, we didn't pay anything for restructuring, so we will just subtract 0. Now, in your actual test or exam, if you have any item have a balance of 0, you don't necessarily need to write it. Okay, it's just for illustration purpose. We showed you everything, but you don't need to write it if the deduction is a 0. Okay. Right. Next item, we're going to have a look of the employee expense. Now, for the employee expense, we do have a corresponding account, which is provision for employee benefit. They do change the wording, okay, so they call it employee benefits, but it's the same thing, okay. So whenever you saw a corresponding account, the first thing you do, you set up your T account. Okay, so let's have a look of the T account. So we have provision for employee benefit, which is a liability, which means opening balance on the right hand side and closing balance on the left hand side. Okay, so will your employee benefit expense increase your provision or decrease your provision? Think of the transaction. When you increase your provision for employee benefit, you will debit your employee benefit expense and you will credit your provision for employee benefit. So the employee expense increase, therefore the provision for employee benefit will increase as well. So they go hand in hand, so they increase at the same time. So when you have an employee benefit, it actually increase your provision for employee benefit. Okay, so it will be on the credit side because it increase your employee benefit. So how much do you actually paid for provision for employee benefit? You paid 650,500. Okay, so which one is deductible for tax purpose? The expense under accounting or the cash you actually paid for the employee benefit? Remember, tax is all about how much cash you paid or received. Okay, so in this case, the 660,000 employee benefit expense is not deductible for tax purpose, whereas the employee benefit leave that you actually paid in cash is deductible. So if it is deductible, you will subtract that. If it is not deductible, which is 660 expense under accounting purpose, you will add it back. Okay, so let's have a look over the answer. So 660 expense for accounting purpose, you will add it back because it is not deductible for tax purpose. But the actual cash you paid for employee benefit, which is 650,500, that will be your deduction. So what do you do with your deduction? You subtract. Okay. Now, one more item. There's another item. It's called rent revenue. Okay. So up to now, all we're dealing with are expenses, right? So for the rent revenue, it's part of your income, so it will go the opposite side. Okay, so now we're not thinking about deduction, we actually think about when we will be taxed on that item. Okay, so with rent revenue, we have made a rent revenue of 50,000. When will you be taxed on your revenue? Again, for tax, it's all about cash. Okay, so you will pay for tax, okay, for your revenue when you actually receive your rent revenue in cash. Okay, so suppose if your tenant paid your rent 10 months in advance, okay, you will pay for tax for all of that. As long as you receive it in cash, you will straight away pay tax on that. Okay, so it doesn't matter if you earn it or not. We don't actually care. We only care about whether you receive it in cash. Okay, so we have a rent revenue of 50,000, but it doesn't necessarily mean that we receive all this in cash, right? We do have a corresponding account called unearned rent revenue. Okay, so we need to work out how much rent revenue we actually received in cash. Okay, so whenever we have corresponding account, the first thing we do, we set up T account. So let's have a look of T account. For unearned rent revenue, it is part of our liability. Okay, so opening balance on the credit side and closing balance on the debit side. Okay, so we don't have an opening balance, but we do have a closing balance of 50,000. Okay, now the second question you need to think about is whether your rent revenue will increase your unearned revenue or decrease your unearned rent revenue. Now, unearned rent revenue is the account that keeping the money you received but haven't earned yet, right? And when you actually recognize a rent revenue, it means that you have officially earned this money. If you earned this money, it will decrease your unearned rent revenue. So when your rent revenue increase, it actually decrease your unearned rent revenue. So if it decrease your unearned rent revenue, it will go on the debit side. Okay, so your rent revenue will decrease your unearned rent revenue, which means how much rent revenue you actually received in cash this year. It is 100,000. So the rent revenue you actually received in cash, which is 100,000, will be taxable. Okay, so if it is taxable, what do? Remember, this time we're dealing with revenue rather than expense, so everything go the opposite. So if it is received in cash, you need to pay tax on that. If you need to pay tax on that, it is part of your taxable income, so you need to add it to your accounting profit. Okay, for the rent revenue, because it is not received in cash, so it is not taxable. If it is not taxable, you need to subtract that. Okay, so see everything go opposite because this is revenue rather than expense. Okay, so let's have a look of the answer. So with the rent revenue you recognized this year, which is 50,000, that's not taxable, so you need to deduct that. Whereas the rent revenue you received in cash, which is 100,000, that's taxable, so it needs to be added to your accounting profit. So you will add the 100,000 of rent revenue that you received, and you will subtract the rent revenue you recognize under accounting purpose, which is 50,000. Okay. There's I think the order of the animation is a bit wrong, so we'll just sum up everything first. So once you get all the items together, you will be able to calculate that you have a taxable income of 196,050. Okay, we do have one more item to go through just in a sec. Okay, so when you have a taxable income, you multiply that by 30% and you will get your current tax liability, okay, of 58,815. Okay, we do have one more item to go through, which is under the income we have an insurance claim for loss of profit. So have a look of additional information F. For additional information F, it tells us the other data on 30th of June 2017 include 41,200 relating to an insurance claim that is in process. Okay, and the insurance income is accessible for tax purpose only after the insurance proceeds has been received. Okay, so if it is still in our other debtors account, have we received it yet? Of course no, right? Because it's outstanding in the other debtor account, which means it's our account receivables. We're still waiting to receive those money, which means we do have a 41,200 insurance claim, which is recognized as part of our revenue, but we haven't received it yet. If we haven't received it yet, we shouldn't pay any tax for that. right? We only pay tax for the revenue that we received. Okay, so we haven't received this 41,200. We shouldn't be taxed on that. Okay, and this 41,200 was included as part of our revenue. Therefore, it was originally added into our accounting profit. So what do we need to do? We need to take it out of our accounting profit. So we will subtract this 41,200 because we haven't received it yet. Okay, so until we receive this insurance money, we won't be taxed on that amount. So we will subtract this 41,200. Okay. Right, so we have a current tax liability of 58,815. What is the corresponding transaction? So when you need to pay tax this year, first of all, you will recognize your income tax expense, and because it is your current tax that you need to pay, you will credit your current tax liability. Okay, don't forget to write your narration. Okay. Right, so that's pretty much all for this tutorial. Okay, so hope it helps you a little bit.